Hey there, this is Unit 12, Income Taxation and Basic Investments. This is our accountant unit. So let's put our accounting hats on and let's see what we got in this unit. We are going to talk about some common tax deductions for owners of personal residence, and then we're going to talk about possible capital gains taxes, again, when you sell the property. So the first thing that we need to see or realize or acknowledge coming into this unit, that if you're not a CPA, I can't give tax advice. The best thing we can do is have our buyers and sellers talk to their accountant. The year that you buy, you may have some tax exemptions. The year that you sell, you may have capital gains. Cannot answer those questions because I'm not a CPA. I fear this is one place where students tend to veer out of their lane a little bit. I think maybe we might do our own taxes. And if so, we think we know what's up. But again, you're working with investors, you're working with buyers and sellers. So the best thing that we can do is stay in our lane and advise them to talk to a CPA or an accountant that is very well versed in real estate law. So there's a couple different types of exemptions or deductions homeowners can take. The first type is the deductions that you might be able to take while you still own it. So during the time of ownership, real property taxes may be exempt, or excuse me, not exempt. Real property taxes may be a deduction, a tax deduction. What you make with your regular mortgage interest payment, how much you pay on interest of the year may be a tax deduction. If you purchase discount points when you bought the property, the year that you bought the property, remember discount points are prepaid interest. So they are interest. You're just paying them at settlement instead of scattered throughout 30 years. So discount points may be a tax deduction for the year that you purchased because you prepaid some of that interest. Any late fees and prepayment penalties may be eligible for tax deductions. Loan origination fees, again, the year that you bought the property and you paid those loan origination fees, they may be tax deductible. And then if you have an FHA insured loan, there's a mortgage insurance premium that also may be tax deductible. Now, I know several of you are looking at this and saying, wow, I'm a homeowner. I didn't know I could take real property taxes. So make yourself a note to talk to your accountant this year because that may be eligible for you to take some tax deductions. But again, you guys remember the best piece of advice that we can tell people when they're buying, while they own, and when they sell it is to talk to their CPA. The next set of possible tax deductions is about capital gains. And before we get into capital gains, we need to define a few things that'll lead us up to the capital gains. So first off, your basis. Your basis is just what you paid for it. The day you bought your home, your purchase price is your basis. From our basis, we're going to find our adjusted basis. We're going to take that basis, which is our purchase price, plus any allowable closing costs that you paid as part of the closing, plus capital improvements that you made on the property during the time that you owned it. So what you paid for it, plus your allowable closing costs on settlement, plus any capital improvements that you made on the property during the time that you owned it gives you your adjusted basis. Now fast forward when you're selling the property. Now we're looking at your amount realized, and your amount realized is what you sold it for minus allowable closing costs. That gives you your amount realized. So now to find any possible capital gain taxes, you're going to take your amount realized minus your adjusted basis. So again, the amount realized is what you sold it for minus allowable closing costs. The adjusted basis is what you bought it for, plus the closing costs, plus any capital improvements that you made on it. We're going to see a sample worked out in just a second. Some of you are formula-minded people. Some of you are vocabulary. Some of you like the math. So we're giving it to you every way we have available, and we're going to see this worked out in just a few. Before I get there, though, to finish understanding capital gains taxes, we also need to talk about when that capital gains may be taxed when you sell your primary residence. So first off, please note that says primary residence, which means you were the owner. You were the owner occupant 2 out of the last 5 years, and those 2 years do not need to be consecutive. So primary residence 2 out of the last 5 years. So assuming we've met that criteria, there are some capital gain tax exemptions. If you're single or married filing separately, you have a capital gain tax exemption of $250,000. If you're married filing jointly, you have a capital gain taxes of $500,000. By the way, when we're talking about the sale of a property, not necessarily capital gains, but just the sale of a property, one thing that they will look at is long-term ownership versus short-term ownership. What we're looking at right here is long-term ownership, somebody that owned it for 12 months or more. Now, you wouldn't qualify, but you would still, because you hadn't been there 2 years, but you would still, qualify for that long-term ownership. Compare that to short-term ownership, which is owning the property for less than 12 months. And generally speaking, that short-term ownership is our investor or flippers. And their taxes are going to be part of their cost of doing business. I mean, that's their whole job, is to buy this house, flip it, and then turn around and sell it. So they're not going to be eligible for capital gains taxes because, one, they didn't own the property for 12 months. But they are taxed based off of the cost of doing business, the income, that kind of thing. So focusing on our long-term gains, our primary residence. Put your pencils down for a second. You have an original purchase price of $398 with closing costs of $1,550. That's what you paid for the home, $398, and then you had closing costs of $150. That gives you your basis. Then you add in your 100,000 capital improvements, and that gives you your adjusted basis. So what you bought it for plus what you did to it while you owned it. Now fast forward 20 years, you're selling it for 920,000 and you had 600 in closing costs. So the difference in that, the sales price minus the allowable closing cost, gives you your amount realized. So we can see the adjusted basis and the amount realized worked out. And then the last step is to find capital gains. And capital gains is going to be amount realized minus the adjusted basis. By the way, if your adjusted basis is more than your amount realized and you have a loss, and you will probably be taxed on that loss, talk to your accountant. But in this case, we have a gain. The amount realized minus the adjusted basis gives us a capital gain of $419,850. So now let's say you're single or you're married filing separately. We have your capital gains, and that's where those tax exemptions are going to kick in. This person that is single is going to be eligible for $250,000 tax exemption, which is going to knock their taxable capital gains down to $169,850. I made a number up, assuming the tax rate is 15%. I am not an accountant, but we made a number up figuring 15%, which means your tax bill will be $25,477.50. Now, I know you might be choking a little bit thinking, gosh, that's a lot of money. But if you didn't have that exemption, you would be paying 15% on your capital gains straight from the $419,850. So now your tax bill that year would be almost $63,000. I'm getting $62,977.50. So it does make a difference. It does help. Again, if you think you're eligible for any of this, talk to your accountant. That's for you. For your buyers and sellers, you need to make sure you're telling them to talk to their accountant. This next section, we're going to talk about some loose ends like the 1031 exchange and just some basic real estate investment concepts. So that tax deferred exchange, also known as a 1031 exchange, also known as a like-kind exchange. We mentioned this very briefly in Unit 8 when we were looking at our offer to purchase and contract, standard form 2T. You may want to go back and review that. But for the taxation piece, what we're saying, this is an IRS program that allows an investor to sell an investment property, use the proceeds of the sale of that investment property to buy another investment property. And as long as they are buying an investment property with the money from the sale of an investment property, the investor may be eligible for a tax deferred exchange, which means they wouldn't have to pay taxes on the sale of that investment property. They're exchanging investment property for investment property and deferring paying those taxes. It's a great program for investors. Again, you guys, if you're an investor or if you're working with an investor, it's worth mentioning. And of course, advise them to talk to their accountant to make sure they're taking full advantages of everything that they can. There are plenty of restrictions that apply. I don't want to make this sound easy because there are rules that the investor has to follow. But we can help point them in the right direction for the accountant to explain those restrictions. Equity, we've talked about equity. Equity is your money. It's the money that you have in the home. So to find equity, the formula is value minus debt. What is the fair market value of the property minus what do you owe the lender or lenders, your mortgage debt? Value minus debt gives you your equity. It's the money that you have in the property. We also talked about equity buildup. And there's 3 ways that you can increase your equity, and they all revolve around increasing your value and decreasing your debt. So to increase your value, maybe the property has seen appreciation, or the neighborhood or the area has seen appreciation, which means the property has gained value. The other way to have an increase in value is a capital improvement. Remember, we're not painting a room. We are, good rule of thumb, are you adding square footage? So you're finishing the unfinished basement, maybe adding a room at the back of the house. So how we increase value is appreciation and capital improvements. How you decrease debt, pay off your loan. Every time you send in your mortgage payment, the principal reduces the balance. So as you pay that loan off, you're reducing your balance, which is decreasing your debt. Please keep this simple. Equity equals value minus debt. As mentioned, appreciation is the increase in value for any reason. Maybe we've had a strong seller's market and prices have been up. Maybe there's new jobs coming, new warehouses, plants coming to the area, and that's driving the values up. So whatever reason may be causing an increase in value is going to be appreciation. Another investor's term is leverage. You might have heard the old saying, it takes money to make money. And that's what we mean by leverage. The investor is taking advantage of borrowed funds. They're using debt to increase their leverage. Some investors may have the cash to purchase this investment property, but they still choose to take out a loan so they can leverage their investment. So let's see what we mean by that. We've seen this formula before. We saw this back in Unit 7 when we looked at our income capitalization approach. And we saw for the net operating income. When we were talking about operating expenses, one thing we said that does not count as operating expenses would be your debt service. So your debt service is your principal and interest. It's not your whole mortgage payment, but it's your principal and interest. It's what you owe the bank. Debt service does not get calculated in operating expenses. If you're calculating for NOI and you see debt service is a distractor. So now if I were to take this formula a step further, if we're not counting debt service and operating expenses, then what we're going to do with it is deduct it from the net operating income to get your before tax cash flow, pay your taxes, and now you have after tax cash flow. Leverage would be using that debt service to pay less taxes. If it makes sense for that principal and interest payment, that's how you would leverage your investment. Because if you didn't have that debt service, then you would be paying taxes directly from your net operating income. So it's something the investor needs to consider, but oftentimes they will use that borrowed funds. Generally don't have a 30-year term. They may have a 15-year term that they still pay off early, but they're taking advantage of that leverage. They're taking advantage of that loss, that use of borrowed funds to leverage their investment, to leverage that property. The other thing investors care about is percentage of profit or loss. So we have a T-bar. You may want to pause it here so you can jot this down so we can talk about it. I don't think you're going to see the math. Possibly on the state exam, maybe one question, which is why I want to go over it here. So we have our amount made or lost as part of our amount paid, and then the rate or percent is the percentage of profit or loss. The amount paid is what you paid for it. Back in the day when you bought it, what did you pay for it? The amount made or loss is going to be the difference in what you sold it for minus what you paid for it. And that's going to give you your amount made or lost. So let's say, for example, let's just make some numbers up real quick. Let's say, for example, you paid $100,000 for it. You sold it for. Yeah. No, that's what I just said. You paid. We're going to see a real example in a second. So you paid $100,000 for it. You sold it for 120. So the difference, the number that goes on top would be the difference. The difference in what you paid for it minus what you sold it for, or either way. You may have a negative number up here. If you have a loss, then you sold it for less than you paid for it. And then your amount paid would be that $100,000. So the trick here is finding that amount paid. What you paid for it or what you sold it for minus what you paid for it. So let's look at a couple problems together. Again, you may want to pause it and work it out so you can have an opportunity to work with this problem. So if I buy property for $200,000 and sell it for $245,000 2 years later, what was my percentage gain? So we've read the problem. We're going to go ahead and throw down a T-bar. And for these, just by the name, we can tell that what we're solving for is going to be the percentage. So we're looking for the percentage of gain or loss. So you bought the property for $200,000. So your amount paid is $200,000, and you sell it for $245,000. So the number that goes on top is the difference between what you sold it for versus what you paid for it. So that difference is $45,000. That's the number that goes on top. The back fourth line in the T-bar means divide. So we're going to take 45,000 divided by 200,000. And that gives me 0.225. Or if I move that decimal over 2 places to the right, I get my percent of profit. This investor's percent of profit was 22.5%. Amount made or lost as part of amount paid. Let's see an example of amount lost. Again, you may want to pause it, spend a few minutes with it, and then unpause so we can come back together and talk about it. This one says if I purchase a property for $450,000 and sell it 3 years later for $375,000, what was our percentage of loss? So again, we're going to throw down the T-bar. We're going to use our X. You purchased the property, your amount paid was $450,000. You had a loss, which really we didn't need the problem to tell us that because you bought it for $450,000 and you sold it for $375,000. So you didn't sell it for what you paid for it. If you sold it for $450,000, then you would have broken even. But you didn't. You sold it 3 years later for $375,000. So now we're going to find the difference. And I like to do the bigger number on top, so I'm not dealing with negatives. All I need is the difference. So 450 minus 375 gives me a difference of $75,000. And that's the number that goes on top. The back fourth line in the T-bar means divide. So we take 75,000 divided by 450,000. And that gives me 1.667, or if I move my decimal over 2 places to the right, I convert my rate to a decimal, and you can see this investor had a loss of 16.67 or 16.7%. So again, the number on top is the difference. It's either going to be paid minus sold, or in this case, sold minus paid. To not deal with negatives, you're not going to see negatives on the test. So you're going to get the same answer either way. I just know sometimes that negative symbol messes us up a little bit. That is all of Unit 12 as you're preparing for your state exam to go through the entire unit. Again, if you ever have any questions, don't hesitate to reach out and let me know.